Welcome, everybody, to Lenders Online Commercial Real Estate Series. I'm Dave Stauffacher, your senior credit trainer, and over there is Joe, your senior credit trainer as well. Hi, Joe.
Howdy, David. Thanks.
Well, if you remember our prior episode, we discussed collateral fundamentals. Remember, I'm a fundamentalist. We talked about loan to value, we talked about loan to cost, and some other factors that actually influence real estate values. Now, if you haven't watched that episode, we encourage you to go back and watch it. We thought it was pretty good and it talked about fundamentals. Well, today we're actually going to begin our discussion that actually builds on that foundation. Now, the last time we mentioned briefly about regulatory loan to value limits. So that's what we're going to talk about today, what it means, how it impacts your institution, and do we as individual lenders, does it even matter to us? So, Joe, give us some insight.
Yeah, and just a little bit of terminology here on the front end, David. I'll use the terms regulatory loan to value limits, and I'll also use the term supervisory loan to value limits. Really synonyms, no real difference there. But the deal is why we care. History has shown that real estate losses often begin when lenders advance too much money against collateral that ultimately doesn't support the loan balance. Property values fluctuate, markets change, vacancies increase, maybe construction projects fail. You're in a bad spot at that point. The supervisory LTV limits are designed to provide a cushion when those events occur. So regulators have established maximum supervisory or regulatory LTV limits based on property type. And the limits are 65% for raw land, 75% for land development, 80% for commercial construction, and then 85% for improved property, residential construction, and farmland.
So looking at those percentages, you can actually really see that regulators, as to how regulators view risk. Raw land receives the most conservative treatment. I do know you mentioned farmland a little bit later, but generally raw land. Construction and development receives some tighter limits. I can understand that. Income producing real estate receives slightly more flexibility. And then, I think all this is not accidental. There's tons of research over the decades that actually from lending experiences and historical loss data. So, you know me, I like to do examples. So let's make it practical with people. Suppose our borrower wants to construct a commercial building. We'll just say it's worth $2 million. Nowadays, it's probably very cheap. So under our guidelines at 80% loan to value, I could probably support a maximum loan of $1.6 million. So you got some equity in there, about $400,000, right? If I do the simple math.
Yeah. No, but let's take that a step further. Now let's assume the borrower requested a $1.8 million loan instead. They wanted an additional couple $100,000. So that would be a 90% loan to value. Can the lender make that loan? Possibly. But now the loan exceeds the supervisory limit. So in that case, the lender would likely need to document the exception, justify the decision, and monitor it accordingly. It also goes on a report. You're limited to how many of those you can get per your bank's asset or capital size.
That's an important point. You mentioned exception loans. They require probably some exception level analysis. And that's why the supervisory limits it's not like an absolute prohibition. It's a definite no. But it does raise a flag to say, okay, we need to monitor it. We need to justify why we actually are doing this. Is there a reason behind that clearly supports why this exception, because it didn't fit the percentage of loan to value, why we want to do that, right, Joe?
Yeah, absolutely. And what I always say is exceptions should be exceptional. Okay, this should not be normal course of business for anyone. They should be treated as exceptions. But let's switch gears a little bit and talk about why regulators focus so heavily on these collateral margins. So suppose property values decline by 20%. Okay, if you started out with a 75% loan to value, there's still probably some meaningful collateral protection. But if you started out at 90% loan to value, that protection disappears quickly. You're probably actually upside down on that property. So that margin for error becomes much smaller.
Yikes. Yikes. I can understand why LTV limits basically are important, as we addressed earlier. The future is unknown, right? Some borrower equity today may look good, but is it enough buffer against future events? I just did a webinar series for our learners at Lenders Online Training about the Great Recession of 2008. This touched on that, right? In our portfolios, because the real estate values dropped significantly, all our previously thought of loan to values decreased significantly, and banks had to deal with that. Yeah. So it does matter that what we think is, why are you using, this percentage? I mean, why do you want some skin in the game? Well, that cushion does help us as bankers, and quite honestly, I would say even investors, as to what that future may happen. So I get it. Let's talk about this. What is this, 100, 300, this rule? What is that about?
Only credit nerds like me pay attention to stuff like that. No, I joke. But we're going to next expand from loan risk to portfolio risk. So this is where we encounter the 100-300 rule. I will share with you that credit unions are not necessarily beholden to this rule. It's mostly just commercial banks. But the same thought process comes into play. It's about concentration restrictions. So many lenders understand those individual loan limits, but fewer understand that regulators also evaluate concentration risk. They look at the big picture. The concern isn't just whether one loan is safe, it's whether too many similar loans are accumulating within that same institution, within their portfolio. So the 100 rule states that construction and development loans generally should not exceed 100% of capital. Okay, there's a little bit more to it than that, but that's really it in a nutshell. So your construction and development capped out at 100% of your capital level. The 300 rule states that total commercial real estate loans generally should not exceed 300% of capital. So that's the 100-300 rule.
I think that's interesting. It's a very telling that regulators, and specifically how they isolate construction lending. Right, construction loans carry additional risk. Projects encounter delays. Projects encounter cost overruns, cost increase. We experienced that a few years ago. Tenants, just may not actually materialize. Right, we've got all these tenants lined up, but they haven't signed a lease yet. Absorption can slow. I mean, there's so many reasons on these properties, and that the entire course of our Lenders Online commercial real estate talks about these risks, right? What we go through when we do our analysis, especially when we talk about construction lending. I mean, I have a case in point, even in my other job that I work with, is we've had some projects that there were overruns, project challenges and delays. And, you and I have talked to this over the years, was, once we approve it and the construction begins, we're into this. We're married into this project. We don't like that it went overrun, but how do we deal with that? So that's interesting, Joe.
Yeah, agree. And, construction lending is a really easy way to lose money as a bank. Yep. When you do it and do it well, it can be very, very good for the portfolio, for profitability, but it requires a lot of monitoring and a lot of structure. Now, I will say that construction lending, it's not inherently bad. It simply introduces additional uncertainty. To your point, a lot of stuff can happen while that thing is being constructed. So this is why regulators monitor those concentrations and monitor construction particularly so closely.
All those projects start out with great intentions, right? But reality hits, unknowns happen, and then what do we do with it? That's important from that. Mm-hmm. All right, I want to talk a little about, throw in an example on portfolio risk, because quite honestly, when I was a banker, I was focusing on individual loans. I didn't really care about the portfolio. I didn't know what the percentages were. But I mean, I would suppose if a bank had, like, we'll take 30 million in capital using the 100 rule, basically construction developments, they're kind of limited at about $30 million. But if you're looking at the total commercial real estate, well, we can go up to $90 million of lending. So, I mean, it's kind of that, 100 or 1 times, 3 times multiple of what we're dealing with as a portfolio. Make sense?
Yeah, yeah. Now imagine in that scenario, the bank is approaching those levels. We're getting close. We're maybe bumping up against them. A borrower walks in, they're requesting financing for a really well-structured construction project, okay? Strong contractor, strong guarantor, strong collateral. On its own, it looks like a really good credit. It's probably one I want to take a good swing at, right? But now we have to think big picture. Management has to consider something larger because we're bumping up against our limits. So what does this new loan do to the overall concentration risk of the institution?
I think this is a good topic for our newer lenders, our new analysts, kind of as they develop professionally. You start out in the individual careers, like myself, we focused on individual loans, developing it, increasing the portfolio. But as we gained some experience, we started to learn what's in our portfolio, in any type of investment portfolio. Once you accumulate significant dollars in it, you start to enhance the risk position. So, Joe, let's talk a little bit about these rules and how do they work together and make it simple for us?
Yeah, for sure. So one of the biggest mistakes that lenders can make is kind of viewing these concepts separately, right? You could have high LTV loans, maybe significant exception tracking, growing construction exposure, and maybe increasing CRE concentrations. So individually, each one of those probably manageable, right? But when you start talking about if that's all in the same bank and the same portfolio, that can really create significant risk.
So true, exactly. I remember a mentor of mine that in my earlier days of banking, he would always have this famous line that he used, that risk often doesn't arrive all at once. It accumulates.
Mm-hmm.
I've never forgot that. I never forgot that in anything that I do. So I think it's precisely what regulators were trying to get to and what they attempt to monitor. That risk slowly starts to develop it. And quite honestly, if we don't take attention to it, all of a sudden it's there. And what do we do? Okay, here's our take it to the bank. Remember, we're doing this special thing, take it to the bank thing. Kind of like, so Joe, before we wrap this up, can you give our listeners something that they can take it to the bank?
Absolutely. Love the new segment.
Yeah.
Here's today's take it to the bank. So many lenders will ask, is this a good loan? Regulators ask, well, what happens if hundreds of similar loans experience stress at the same time? And that's what they're more concerned about. That's the difference between loan level risk and portfolio level risk. A loan can have strong cash flow, strong risk profile, strong collateral, strong guarantors, but it can still contribute to excessive concentration risk if too many similar credits already exist within the portfolio.
So a good loan is not always a good portfolio decision. That's something you can take to the bank. Strong lenders evaluate credit. Strong institutions evaluate portfolios. And understanding both perspectives, I think, can lead to better loan decisions, better institutional well standings. So let's wrap it up. Now, we know supervisory loan to limits, that there is something for each property type. Use exceptions. Remember, exceptions are not totally prohibited. You can have those, but just understand those and justify why you're doing those. Document. I've always said that in our training classes. I believe in it. Understand what regulators evaluate. It's a little bit more than just the individual loan that you are doing at this time. Understand they also look at the portfolio. But it's a matter of how the bank's overall risk and how they view the commercial lending real estate, how it fits. Joe?
Absolutely. So remember, collateral fundamentals matter. Strong underwriting matters. But concentration management matters as well. The healthiest institutions understand all of these and how they interact with each other.
Well said, Joe. If you have any questions about commercial real estate, and I hope you're finding excitement in this commercial real estate series, hope you found it informational, reach out to us at experts@lendersonlinetraining.com. If you're enjoying the series, share it with a colleague, share the word, subscribe to our future episodes, send us a question because we love the questions on the specifics. Joe?
Yeah, absolutely. So please join us next time. We're going to continue building on the fundamentals of commercial real estate lending.
All right. Goodbye, everybody. Take care.